At some point in your career, your company offered you equity. Maybe it came with an offer letter. Maybe it showed up after a promotion. Maybe it was framed as a part of a compensation package that sounded compelling in the room and confusing on paper afterward. The equity is real. The manual was probably never included, though. By the end of this video, you'll know the three primary forms of equity compensation and what makes each one structurally different, and why identifying which one that you have is the first decision that determines every decision that will follow. So equity compensation is not a single thing. ISO, NSO, RSU, these are not interchangeable terms for the same asset. They are structurally different instruments with different tax treatment, different exercise mechanics, different windows, and different consequences for getting the timing wrong. Now, when people treat them as variations of the same thing, they're making decisions without the complete picture. The type of equity determines the decision. The decision determines the tax outcome. And in a number of cases, the window to make that decision is shorter than anyone ever warned you about. The most straightforward of the three, here we go, is a restricted stock unit, an RSU. Is a promise from the company to deliver shares at a future date, contingent on a vesting schedule. The executive does not own the shares until they vest. There is no purchase decision, there's no strike price, and there's no exercise window. When the RSUs vest, the value of the shares at that moment is recognized as ordinary income, taxed as the same rate as your salary. The decision point for RSUs is not whether to exercise. It's what to do with the shares immediately after vesting: hold, sell, or diversify. That decision has tax implications and concentration risk implications that are worth examining before the vesting date, not after. A non-qualified stock option, an NSO, gives the executive the right to purchase company shares at a fixed price, otherwise called the strike price, at some point in the future. Now, the gap between the strike price and the market price at exercise is the spread, and that spread is recognized as ordinary income at the time of exercise, regardless of whether the shares are sold or not. NSOs can be granted to employees, contractors, and board members. They carry no special tax treatment. The tax hit is immediate and ordinary at exercise. The strategic question is timing, like when to exercise relative to the executive's broader income picture in that tax year. Incentive stock options, ISOs. Now, these are the most complex of the three, and they carry the most decision weight. So like NSOs, ISOs actually give the executive the right to purchase shares at a fixed strike price. The structural difference is the tax treatment. When ISOs are exercised, the spread is not recognized as ordinary income. It is a preference item for alternative minimum tax purposes, also called AMT. If the shares are held long enough after exercise, the eventual gain, it may qualify for long-term capital gains treatment rather than ordinary income rates. That spread between capital gains rates and ordinary income rates is meaningful at a high income level. The trade-off is risk. Exercising ISOs, it means purchasing shares before knowing what they will be worth. In a private company, those shares may have no immediate market. The executive holds an asset, owes potential AMT, and cannot necessarily sell to cover either. ISOs also carry a hard expiration. They must be exercised within 10 years of grant and within a much shorter window after leaving the company. So, 3 instruments, 3 different tax outcomes, and 3 different decision timelines. The executive who knows which one they have is starting from the right place. The one who's been treating them as roughly equivalent has likely already passed a window or two without realizing it. So if this raised questions about what you are actually holding, drop them in the comments. The next video is going to go into the tax layer, what each of these costs at the moment of decision, and how the timing of that decision changes the outcome.